So yes, Hitanshu, I just mentioned about you. I was saying Hitanshu hasn't joined yet. Anyway, first few minutes we ask questions. So I will ask theory questions. Who can tell me what is a cash generating unit? Hitanshu, can you tell me what a cash generating unit is? Cash generating unit. I'll give you 2 minutes to kind of type. You can unmute and speak. So we were in chapter, I think, 4. We were completing 4, and today we're supposed to move to the 5th chapter. Oh, okay. You attend the classes from library. That's fine, not an issue. Anyway, guys, today the 4th chapter will be over, and we move to the 5th chapter. 5th chapter. Anyway, I'll just quickly do my CGUs. Okay. Cash generating units. And as you all know by now, that the first 10 minutes I ask questions. But because I want to do numbers for CGUs, I want to do a quick recap of CGUs. And one more thing that we're doing is taking attendances now. Attendances, as in now, we're not just kind of uh, just taking classes randomly. We're taking attendance of who all are attending classes live, who all are attending classes recordings, and so on. And I don't know if I mentioned this last week, but a few new additions is taking attendance is mandatory. We take attendance now. If it is live, I will take the attendance physically. If it is a recorded class, there what I'm doing is it automatically gets captured. So we can see how many classes did you watch, how many, for how long did you watch, how many times did you watch. So that is our way to see if our students are there with us. And of course, every Friday, did I mention this, guys, about every Friday? Because the class we had it on Tuesdays. I believe I've mentioned. Did I mention every Friday there will be a test? Yes. Every Friday there is going to be a test uploaded on the LMS. You have time until Monday. All this I've mentioned, so great. So now we're doing cash generating units. What is a cash generating? See, guys, in every business, please just excuse me. So, who is this? In every business, there will be what? There will be assets that we use to generate cash. We use assets to generate cash. For example, in Chartered Academy, what do I have? I have a laptop, I have a projector, I have things like my charger, I have tables, I have AC, right? But all these assets together help us generate cash. But which are the smallest in number? Which is that group that can independently generate cash without any other assets? For example, if you ask me, If you ask me, for example, in my institute, laptop and charger, just the laptop and charger can help me earn money by God's grace. So my laptop and charger are the smallest group of assets. It's a group because it's a laptop and a charger. If I have these two, I can take classes from anywhere in the world. So the smallest group of assets, it's the smallest group of assets that will be used together in order to generate cash. And that, guys, is a CGU. It is 5:39 now, and now is the best time. 5:40 sharp, we start the session. So, guys, now we will look at illustration. What do I mean by illustration? In a restaurant chain, the smallest group of assets might be the assets within a single restaurant. But for a mining company, all the assets might make up one CGU. For example, in a mining company, you cannot mine with just a group of two, three assets. You will need all the assets. Right? In a restaurant, within a restaurant, I gave this example, but just that dispenser, just that chocolate food dispenser itself, let me just show you my screen. Just the dispenser, if you talk about, I'm just showing you the screen. This one. This one. This itself, this and probably the cable connector, whatever all this, these two things alone could be the small group that can earn or generate cash flows. So the smallest group within a business that generate cash flows is known as cash generating unit. Okay. Now, what's the next thing that we have to look at? When it comes to impairment, okay. See, we've seen that assets get impaired. True or false? Assets in the earlier chapter, we said assets are impaired if the recoverable amount is less than the carrying amount. We cannot recover so much. So, what we do is even a CGU can be impaired. So, I will type it here. Just like an individual asset. Just like an individual asset can be impaired, a CGU can also be impaired. Where CGU is also assumed to be one asset and it can be impaired, right? The CGU can be impaired. So, again, what do? You have to compare the carrying amount versus the recoverable amount. And if the recoverable amount is less than the carrying amount, you say that, okay, there is an impairment. Okay. Now, impairment of a CGU, I will explain with the help of test your understanding 3. So technically today is 3rd of April. 3rd of April 2025. And what I am going to do now is this. SEBCO runs a unit that suffers a massive drop in income due to its failure of its technology. Okay, blah, blah, blah. All of that is good. On 1st of Jan 2028. That is also good. The next thing we're looking at is what? The next part is the following carrying amounts were recorded in the books immediately prior to the impairment. So, what do we say? Goodwill 20 million, technology. So, the following carrying amounts, these are the carrying amounts prior to the impairment. Okay, 20 million, technologies 5 million, brands 10 million, land, and so on. Now, the recoverable value of the unit is estimated to be 85 million, which is okay. The technology is worthless following its complete failure. Show the impact of the impairment on 1st of Jan 2028. So again, I will solve this for you, don't worry. But after that, I'll give you a couple of minutes to try it on your own. Okay. How much is the recoverable amount? Test your understanding 3. Recoverable amount is 85 million. How do I know this? Because it's there in the question itself. Okay. And what about the carrying amount? Carrying amount is add up all of this. See, all of this is one unit. The recoverable amount of this unit is 85 million, but the carrying amount you have to add up and tell me. Can you add up and tell me the carrying amount? How much is it? Add up and tell me the carrying amount. 155 million. So the carrying amount is 155 million. 20 million plus 5 million plus 10 million plus 50 million plus 30 million plus 40 million. It is going to be carrying amount 155 million. So again, you are recovering. Think about it. Will you be happy if you recover? Suppose I tell you your mobile is worth 1,55,000, but you will recover only 85,000. Will you be happy if I tell you this? No, right? So obviously here also the carrying amount of the unit is 155 million, but you can only recover 85 million. So there is a big problem. Big problem as in there is an impairment. There is an impairment. So we know that there is an impairment. There is no doubt about that part. How much is the impairment? Look at the difference between the two. How much is the impairment? 70 million. Yes, that's right. So we have an impairment of 70 million. Now, when we impair, what we do is this: technology is completely worthless. Sorry, technology is entire. There's a spider on my table. Technology is completely worthless. How much is technology worth? 5 million. But it is so much impaired that it is completely worthless. See, technology entirely worthless. Right? So technology has to be written down first. Technology, in this example, is entirely worthless. So we write it down first. Right? Remember, there is an impairment loss of 70 million. And in that impairment loss, what do I say? We're seeing who will we allocate this loss to first. So out of this 70 million, we have to allocate this loss to all of these individual assets. But who will we allocate the 70 million loss first? We will allocate it to technology, meaning that 5 million of this 70 million is because of technology. Right? So, how much more loss is left after technology is impaired? After technology, I've impaired technology. 5 million I've impaired for technology. Yes, 65 million is still left. Now, this 65, so again, remember from 70 million, 6 million, sorry, 5 million has already been deducted to technology. So 65 million is left. Now the question is, who will pay this? Who will incur this remaining 65 million? Right? Again, will I incur it from goodwill? Will I take it from technology? Will I take it from brands, land? Technology I have already done. But goodwill, technology, sorry, again, technology already done. Goodwill, brands, land, building, who will incur this 65 million? Again, it will be in the following order. When you impair a CGU, 65 million needs to be impaired. You will first impair goodwill. Now, this is something that IS 36 is teaching you. IS 36 is teaching you that once you have impaired completely worthless assets, you will now impair in this specific order. First, the purchased goodwill. First is who? The purchased goodwill. And goodwill is worth how much? 20 million. So completely 20 million I will. So the carrying amount for goodwill is 20 million. So I will kind of impair that. So entire 20 million will be impaired. Okay. That's done. So obviously if goodwill is completely impaired, there is zero value in goodwill. Then what does the textbook say? The other assets in the CGU will be impaired on a pro rata basis based on the carrying amount of each asset. Now, I have mentioned this in an earlier class, but it's okay if you don't know. See, from 65 million, I have already impaired goodwill. Goodwill was 20 million. So, how much is left? 45 million. Very good. 45 million is left. Now, this 45 million has to be impaired on a pro rata basis. What do I mean by pro rata basis? Again, see, goodwill and technology have already been impaired. Just strike it off. So what is left? Brands, land, buildings. Okay, so what do I do? And again, the question says that the carrying amount of other net assets is a reasonable representation of their NRV. I mean, they are not impaired. So we will only impair brand, land, and buildings. So what do I mean by pro rata basis? It's like brand, how much is the carrying amount? Brand, how much is the carrying amount? See the question and tell me. Very good, 10 million. So brand is 10 million. Out of a total of, think about it, brand, land, buildings, 10 plus 50 plus 30. How much is the total? 10 plus 50, 60. 60 plus 30, 90. Out of 90 million total, brand is 10 million. So what percentage of the total is brands? Out of 90 million, brands is 10 million. So brand is 10 million out of 90 million. So how much percentage is brands? 10 divided by 90? It's 11.11%. So what I will do is 45 million, which I have to impair here, I will impair, I will give 11.11% to brands. So I will say 11.11 into 45 million. How much is it? How much? Quickly give me the answer. It's how much? It's 5,499,999 I got. So brand, I will impair 5 million on brands. Right? What is the next asset? Land. How much is land? Again, I'll redo it from scratch. How much is land? Land is the value carrying amount is 50 million out of a total of 90 million. So land is 50 out of 90, which is how much percent? 50 out of 90 is 0.55555%, which is 55.55%. Sorry. So what I will do is I will allocate 55.5555% of this 45 million to land, which is going to be 25 million, if I'm not mistaken. So 25 million is given to land. Out of that, 45 million. So out of the 45 million, 5 million is given to brand, 25 million is given to land. And then which other asset is left? The next asset left is buildings. Buildings are 30 million out of a total of 90 million. So 30 out of 90 is how much percent? 30 out of 90 is how much percent? 30 out of 90 into 100 is 33.3333%. So 33.3333 as a percentage. Again, what I will do is out of 45 million, I will give 33.33% of the impairment to buildings. So 33.333% of 45 million is?
It's 6 o'clock.
1,500,000. So again, no, it shouldn't be 1,500,000. It should be 15 million, if I'm not mistaken. 15 million. So as you can see, guys, how much is 50 million plus 25 million plus 5 million? How much is it? 45 million. So as you can see, this 45 million has been impaired totally. How much? Brand is impaired by 5 million, land is impaired 25 million, buildings 15 million. So this is how I split the impairment cost. Wherein the first, again, we know that there is an impairment loss of 70 million. The first 5 million has been attributed to technology. Why? Because we said that technology is completely worthless. So the first 5 million was attributed to technology. So from 70 million, if 5 million is removed, 65 million of impairment still needs to be attributed. As per the ruling, first you will attribute impairment to purchased goodwill. So what I do? Remaining impairment is 65 million and I have attributed it to the purchased goodwill, and goodwill is 20 million. So what did I do? 65 out of 65 million, 20 million I attributed it to goodwill. So how much is the remaining impairment loss? 45 million. I hope all of you are following. The remaining impairment loss is 45 million and I have to attribute it to three more assets: brand, land, and buildings. Not other net assets, because the question says that there is no problem with other net assets. This 45 million has been attributed to three assets on a pro rata basis. What do I mean by pro rata basis? The total for brand, lands, and building is 90 million, out of which brands is 10 million. So 10 out of 90 is 11.11%. So 11.11% of this 45 million will be attributed to brand, which is 5 million. Moving on. Land also, again, same concept. The total for land, brands, and building is 90 million, out of which land is 50 million. So it will be 50 divided by 90. So you will get a percentage, which is 55.55%. So 55.55% of 45 million will be attributed to land. Moving on. The last asset is building. Building is 30 out of a total of 90. So 30 out of 90, which is 33%. So 33% of this 45 million will be attributed to buildings. So the key takeaway here is, first step, impair the asset which is entirely worthless first. First, in this example, it was technology. Second, what will we do? The second thing is impair as per the order, as per IAS 36 order, where we impair purchased goodwill first. So what did we do? Second step, again, see, first step, we know that the impairment loss is 70 million. From this 70 million, first things first, technology. What is the first step? What is completely worthless? Technology. So you impair that. How much is left? 65 million. Next step is impair as per IAS 36 order, where purchased goodwill will be impaired first. And purchased goodwill was 20 million. So 65 million minus 20 million is 45 million. The remaining impairment amount to be impaired on a pro rata basis. Guys, any problems with test your understanding 3? Have a look and let me know. Guys, any problems? Test your understanding 3. Is it crystal clear? Because this is there, no? Here. The other assets in the CGU are impaired on a pro rata basis. First step, impair the asset which is entirely worthless first. Then, as per IS 36, first thing, the order is first you will impair the purchase goodwill, and after that, the other assets will be impaired on a pro rata basis. It's there here. I showed this. Any other problems, anybody? With which this chapter is over. This is the 4th chapter, which has been completed. So technically, we're just starting the class for the day. Then you will start with purchased goodwill first. That's the order. The order is here, no? The order is you start with, see, first you will deal with any specifically impaired asset. In this case, we saw that technology is completely failed. So first do that, and after that, what will you do? You will impair in this order. The order is first is purchase goodwill. So if obviously there is no specifically impaired asset, you have to start with purchase goodwill, and in that order, after purchase goodwill, you will impair on a pro rata basis. Is this clear to everybody? Yes. Now we move on. Guys, this is a fairly interesting chapter that we are going to do. Right, and it's not very big, so I can finish this 5th chapter today, and in fact even move to the 6th chapter if I have complete attention towards this. Okay, so this is a very small chapter, and in fact even the 6th chapter is very small, very easy, very simple. Okay, so what do we do in the 5th chapter? Okay, before we start, I'll give you 2 minutes to have a look at what we've done today. Just test your understanding. Three. See if you understood. Okay. I hope that is clear. Now we're going to look at when is an asset held for sale. Classification as asset held for sale. What do I mean by held for sale? See, it's like I have a car. Okay, I have a car. And this car is suppose, say, I use it. Okay, I'm using this car to, I don't know, transport some goods and all that. Right? Now, what will happen is maybe I may hold this car, take this car, pick it up, and say, okay, I want to hold this car in another garage. This is the garage, and this will be sold. Right? So, see, there is a car, there is an asset, and I will basically recover money or recover benefit from the car by a sale and not by using the car. When I hold the car and I say, okay, I'm going to sell this car, that is asset held for sale. As simple as that. The asset held for sale is where you intend to get benefit out of the asset by selling it and not using it. So an entity shall classify a non-current asset as held for sale if its carrying amount will be recovered principally through a sale instead of a continuing use. For example, if you have a mobile and the mobile has a carrying amount of 40,000. Now, obviously, you want to recover that, no? How will you normally recover that? Guys, how do you normally recover money from this? From an asset, say you buy a mobile, you invest 40,000 in the mobile. How do you recover benefit from that? You will use it, correct? So, normally, if you have a mobile and the mobile has a carrying amount of 40,000, you will recover the carrying amount by using it. But if you don't intend to recover the carrying amount by using it and you say, okay, I'm not going to use the mobile, that mobile is worth 40,000. I will recover that 40,000 by selling it. You decide to recover the carrying amount by selling it. That will be when you say that I have classified this asset as held for sale. Okay, so guys, this is when you say that an asset is held for sale. Now, I hope what is the condition? When will you classify? When to classify an asset as held for sale is clear. Okay. I hope that is crystal clear. Once that is clear and once that is easy, the next thing we have to look at is in order for this to be treated as held for sale. Yes, your intention is there. You want to recover the money from selling it. So your intention is to sell and recover the money, recover the carrying amount. So you feel it is held for sale. But certain conditions need to be met. Number one, in order to say that it is held for sale, I'm just going to show you something. Here. If you say that something is for sale, it needs to be there. What do I mean by it needs to be there? Here I see M&Ms. Here. Meaning M&M is there, no, it is available. So you can say it is for sale. I see Hershey's here. It is there, it is available. So you can say it is held for sale. Right? But I don't see a Amul ice cream here. Or I don't see London Dairy here. I don't see Baskin Robbins ice cream here. I don't see that. Because it's not there, it's not available. Right? And in order for you to say that an asset is held for sale, the asset must be available for sale. Without that, how will you say it's held for sale? You understand? So the first criteria is the asset must be available for immediate sale. First criteria is what? The asset must be available for immediate sale. And again, the sale should be expected to be completed within 1 year. I mean, it's held for sale when you expect that somebody will buy it. Like, for example, I have a broken mobile. I can't say that is held for sale because I don't expect anybody will buy it. So, for an asset to be treated as held for sale, there needs to be a high chance, an expectation that we will sell that asset. We will be successfully able to sell that asset within 1 year. Okay. Third is again, I'm doubtful whether I should sell my laptop or not. I don't know. Sometimes I think I should sell. Sometimes I think I should keep it. This will not be treated as held for sale. This cannot be held for sale. No. You will say held for sale only when you are sure about selling it and there are no, it's very unlikely that you will change the plan. So you will say an asset is held for sale when you will say an asset is held for sale when it there are very slim chances, it is unlikely that we will change the plans. So you will not say an asset is held for sale when you are confused or when you don't know what to do. right? And the sale must be highly probable. Again, as I said, you consider something as held for sale when you are working hard to sell it. Okay. So, one of my tutors, when I was studying in Dubai, used a funny example, right? So, she used an example and said that when will I say, example used by my tutor. I was lucky, I got very good tutors, and that's why my understanding is strong. Used by my tutor is, she said, I am holding my brother for marriage. Holding my brother for marriage means she wanted to get her brother married, right? But I can say I'm holding my brother for marriage only when we are actively looking for active program to look, okay, not buyer in this case, but there is an active search for a partner. Without that, you cannot say this brother is held for sale. Right? So we are actively looking, there is an active program, there is an active search. Now, in this case, obviously, the term now will not be used buyer, but sticking it back to the syllabus, we are actively searching for a buyer. Only then you can say the asset is held for sale. Otherwise, who will buy if you're not actively searching? If you keep your in my teacher's case, if you keep your brother hidden, how will anybody know, right? Uh, and again, you have to actively market. Actively market means you have to actively tell people. In her case, she had to actively tell people that they are looking for a partner for her brother. Same way, when you're trying to sell an asset, you have to actively market and say that we're trying to sell. Active marketing is happening. And her family was committed to marry him off. So, again, in terms of an asset, management must be committed to sell the asset. Just like in her family, they were committed to marry. Okay. So that is when to classify an asset as held for sale. These three plus the fourth condition is there are active efforts. Basically, I'll simplify it for you. There are active efforts to sell off. These four conditions, if they are met, then you can say, yes, we're trying to sell it. Now, next thing is rules for assets held for sale. Now, again, I'm going to give you a basic example so you understand the logic. But say I have a set of shoes, a pair of shoes, right? Pair of used shoes. So I have these shoes that I want to sell. These shoes I want to sell. So when I've held them for sale, I will not wear them and go. I will put it on the counter. Remember that shop where there was counter, there was M&Ms, there was Skittles, there was Hershey's. You have to put it on the counter. You cannot eat it, no? Same way, the shoes will be held for sale. When they are held for sale, it means we are no longer using it. And because we're no longer using it, technically there's no wear and tear because we're not using it. And because there's no wear and tear, there will be no depreciation. And that's why assets held for sale should not be depreciated. So the rules for asset held for sale, these assets must not be depreciated. And because they are about to be sold, they are presented separately on the statement of financial position under current assets. Because even if it's a car, I plan to sell it within 1 year, so it becomes a current asset. They lose the non-current asset status because we are planning to sell it off within 1 year. So they will fall in the category of current assets. These assets will be separately shown under current assets. I hope this is clear and easy for all. Now, the next thing is measurement of non-current assets held for sale. They are measured at the lower of carrying amount and NRV, whichever is lower. Sorry, yes, NRV. Fair value less cost to sell is NRV. So non-current assets that qualify as held for sale should be measured at the lower of carrying amount and NRV, whichever is lower. Just like inventory is valued at the lower of its cost and NRV. Basically, now these non-current assets are held for sale, so they're almost treated like inventory. They are measured at lower of carrying amount and NRV, just like inventory is measured at lower of cost and NRV, whichever is lower. And generally, it is the cost in terms of inventory, at least. Generally, it is the cost that is lower. Now, let's look at test your understanding one. Look at test your understanding one. What does this say? On 1st of Jan 2021, Michelle Co. bought a stamping machine for 20,000. It has an expected useful life of 10 years and a nil residual value. Okay, so that's a good thing. Okay. On September 20, 2023, Michelle Co. decides to sell the machine in. So see, on September, it became held for sale. The machines are in short supply, so we feel that we will definitely sell the machine. So again, it is definitely falling in the held for sale category. Its market value at 30 September 2023 is 13,500, and it will cost 500 to dismantle the machine and make it available to the purchaser. The machine has not been sold, blah, blah, blah. At what value should the machine be stated in Michelle Co's statement of financial position? Again, how much did we buy it at? Cost was 20,000. And see, we bought it in 2021 and only in September we decided to hold it for sale. So 2021 we will depreciate it as usual. 2022 also we will depreciate as usual. So depreciation is how much? Think about it. It has a life of 10 years. So the asset has a value of 20,000 and a life of 10 years. So annual depreciation will be 20,000 divided by 10, which is 2,000. So first year depreciation will be 2,000. Second year depreciation will be 2000. After that, in the third year, we will depreciate only for 9 months. Which are the 9 months? Jan to September. Count it in your fingers. Jan, Feb, March, April, May, June, July, August, September. Third year, we will only depreciate for 9 out of 12 months. So think about it. If the yearly depreciation is 2000, monthly depreciation will be 2000 divided by 12. In 1 year, there are 12 months. And in 1 year, if we depreciate 2000, monthly we are depreciating 2000 divided by 12, which is 166.66666 or 166.667. If the monthly depreciation is 166.67, 9 months from Jan to September will be 1500. Yes. So the third year depreciation, please, guys, I've calculated how did I get that. Third year depreciation is 1500. So this is the depreciation that we charged so far. Therefore, at this date, the carrying amount of the asset is 20,000. Again, I'm taking off this calculation. And 3 years depreciation is 2000 plus 2000 plus 1500, which is 5500. So 20,000 minus 5500 is 14,500. So the date I'm holding this asset for sale, the asset has a carrying amount of 14,500. Carrying amount is 14,500. And what did I just tell you? Assets held for sale should be measured at the lower of carrying amount and NRV. Carrying amount, I know, 14,500. Can I calculate fair value less cost to sell? Yes, I can. How much is the fair value? The machines are in short supply, so Michelle Co is confident that we will sell it. Its market value is 13,500 and there is a cost of 500 to sell. So fair value less cost to sell is 13,500 minus 500. 13,500 minus 5, which is 13,000. And what did I say? Asset held for sale is valued at the lower of carrying amount and fair value less cost to sell. Therefore, we will value this non-current asset at 13,000. I'm putting that in bold and making it black. We will value this asset at 13,000. Once reclassified as asset held for sale, we will no longer depreciate this machine. Right? Guys, that's it. With that, this illustration. Right? But here, the carrying amount is 14,500 and we are writing it off at 13,000. So there is an impairment of 1,500. So it's an expense. But again, we don't need to worry about that here because we've done it in the previous chapters. But we just need to know that we will measure this asset at 13,000. So guys, test your understanding 1 is over. You can have a look at this. I've explained this in my words and also given notes for that. Just let me know if there's any problem. Welcome, guys. We're just continuing the next, we're just moving to the next topic, which is discontinued operations. Discontinued operations is a part of business that you no longer are doing. It could be a line of business that you've stopped, you've sold it off, or you've decided to hold it for sale, but you no longer are continuing those operations. Maybe, say, for example, I say, okay, I will not, for example, I decide not to, I stop teaching. That would be like a discontinued operation, a part of a business that has either been sold off or is held for sale. That is discontinued operations. And we will understand discontinued operations better by looking at test your understanding 2. Saint Valentine produced cards and sold roses. However, halfway uh, through the year ended 31st March 2026, the rose business was closed and the assets were sold off, including losses on the disposal of non-current assets of 76,000 and redundancy cost of 37,000. The directors recognized the continuing business at a cost of 98,000. Trading results have been summarized as follows for cards and roses. Draft the statement of profit or loss for the year ended 31st of March. Okay. So, how do we do this? What do we do is the question. Uh, Again, roses were stopped, correct? The rose business was closed. Okay. But the cards business is continuing. Cards business is continued. So we will separate the two. Cards is continued, roses is discontinued. So the first step is to bifurcate between which part of the business is continued and which part of the business has been discontinued. Once that bifurcation has happened, you will separately show for cards and separately show the numbers for roses. I will start off with cards. These are our continuing operations. Again, the revenue is 650,000. Cost of sales is 320,000. So this is something we saw in the first chapter. Revenue minus cost of sales is the gross profit. 650 minus 320,000 is minus 320,000 is 330,000 gross profit. Then you have other expenses, admin and distribution, admin expense, distribution expense. Admin is how much? 120. Distribution is how much? 60,000. So once you deduct admin and distribution, you get the operating profit or profit before interest and tax. So from 330,000, if we deduct 180,000, why 180? 330 minus 120 plus 60, 180. 330 minus 180 would be 150,000. So operating profit is 150,000. From this, you have to deduct other expenses such as interest and tax. Interest is 17,000 and tax is 31,000. So we look at that, but it's 150,000, right? And in addition to that, the directors recognized the continuing business had other reorganizing cost of 98,000. So this continuing business that I'm doing, there is an additional cost of 98,000. This is for reorganizing the business because one business I've sold, one business I'm continuing. So a little bit of reorganizing needed to be done. So from the operating profit, I will deduct reorganization cost, reorg costs, which is 98,000. So how much does it become? 150 minus 98,000 would be 52,000. From that 52,000 again, the finance cost, I told you, finance cost is 17,000. Therefore, you will get the profit before tax of 98,000 is the reorganization cost. Operating profit was 150. And from 150, if you deduct 98,000, it's 52,000. From 52,000, if you deduct 17,000, it's 35,000. From this, you will simply deduct the tax. Tax is how much? Income tax is 31,000. Therefore, the profit for the continued operations is 35 minus 31 is 4,000. This is for continuing operations. As simple as that. Now that we have continuing operations, we will show discontinuing operations, roses. How do you do discontinued operations, roses? What do you do? Same thing. Again, roses had a revenue of 320,000. Cost of sales is 150,000. So the gross profit will be 320 minus 150. Minus 150 is 170,000. So gross profit is 170,000. From that, again, admin, distribution. Admin is 110,000. Distribution is 90,000. So basically 200,000. So you have your PBIT, profit before interest and tax, also known as your operating profit. Your operating profit is from 170,000. If you deduct 110,000 plus 90,000, it will be again 170 minus 200,000 will be a loss of 30,000. That's why we discontinued this, no? It was a loss. We were losing money. 30,000 was a loss. And one more thing, go to this information. The rose business was closed and the assets were sold off, incurring losses on the disposal of. So when we sold assets, that time also we had further loss. We had a loss on disposal. This was the operating loss, but we had a loss on disposal also. The loss on disposal was 76,000. So loss is increasing. And we had a redundancy cost because obviously I've stopped the activities. So I cannot pay the staff. I have to ask them to leave. And the redundancy cost was 37,000. 37,000. So that's also something that needs to be deducted. So 30 plus 76 plus 37. There is an overall loss of 143,000. That's why I left and stopped this business. It was a loss. So we've done continuing, there is a profit, and for discontinued operations, there's a loss. Do you understand? So there is a profit of 4,000 for continuing operations. There is a loss of 143,000 for discontinuing operations. So the total profit or loss for the year, will be 4,000 is profit from continuing operations, minus there is a loss of 143,000 from discontinued operations. Therefore, we have a total loss of, think about it, 4,000 is the profit, but remaining everything is loss. So we have a total loss for the year of 139,000. It's a total loss for the year. I hope this is clear and comfortable to everyone. Okay. And that's what we've done here. We showed the continuing operations, we showed the discontinued operations, and we've got the total profit for the period. Now, explain how IFRS 5 discontinued operation presentation can make informed. So, I'm doing test your understanding 2. And I have reasons to believe I've done test your understanding 1 also. Test your understanding 1, test your understanding 2, A and B. What do I mean by B? B is explain how IFRS 5 discontinued operation presentation can make information more useful. See, because you are discontinuing operations, IFRS 5 requires you to separately present the discontinued operations on the statement of profit or loss. By showing separately, any users, any viewers, any users can immediately identify and bifurcate. Identify that the performance related to the discontinued operations or discontinued segment will not continue because it is discontinued. So they immediately have a relief. So, for example, here they know that there's a loss of, oh my God, 143,000. But when you show it separately, they know, okay, this 143,000 loss will not continue in the future. So it really helps any users to make informed decisions. And that is what we've seen in Test Your Understanding 2. Okay. With which Test Your Understanding 3 would be given for you to try on your own. Would be like homework for you. Homework as in what? Self-assessment. With which this chapter is over. We've seen held for sale. We've seen measurement of non-current assets held for sale. We've seen discontinued operations. As I said, it's 6:54. In 1 minute, we will go and take a break. The 6th chapter that we are going to do today. So as I said, we're reasonably at a good pace because 1, 2, 3, 4, 5. It's our 5th class and we're in the 6th chapter. And believe me, The last few chapters on consolidation, although people struggle, they are actually easier, right? So, ideally, by next Tuesday, we should be in a position to kind of be in like the seventh or eighth chapter. All right. With that, you can take a break, come back in 10 minutes. Yes, guys, come back. Welcome back. Uh, we're now going to look. Can you confirm that you're here? I just need you to confirm that you're here. Yes. So, as I mentioned, this is our timetable, right? So, another 40-45 minutes of class, and I'll try to complete the sixth chapter in this session. Okay. So, yeah. Now, here what are we learning? Right? We're learning about why regulation is needed, right? And why a regulatory framework is necessary. See, when we are preparing financial statements, all users must receive a minimum amount of information that will help them in making good decisions, right? How will we how will we ensure that a minimum amount of information is available? How will we ensure this? Right? We need to have rules, we need to have a regulatory framework where we are ensuring that relevant and reliable financial reporting is ensured, right? We need a framework in place that will ensure that relevant and reliable financial reporting happens. Both relevant and reliable. And that will only happen when there is a framework in place. Okay. Now, there are two things. One is the principle based framework, and the other is a rules based framework. In the UK, there is a principles based framework. Now, we will come back to what is principles based and rules based framework in more detail. But remember that we are now a very big, the entire world is like one small village now. Right? And if everybody is using different standards in preparing financial statements, it will be very difficult. Today, business is again, I'm underlining, I'm not giving my many analogies because this is like as straightforward as it can be. It cannot be more straightforward. Everybody knows that businesses are now getting more and more global. Investors are now making investment decisions on a worldwide basis. Therefore, we need what? We need unification. unification, we need commonization, we need harmonization, where the methods used and the way financial information is presented is commonified, is harmonized. When I say harmonized, I mean it is made consistent. It shouldn't be like, oh, in India I see something, in UK I see something, in the Middle East I see something, in Singapore I see something. It shouldn't be the case. Do you understand? So we need harmonization. Harmonization means what? We need to ensure that we're consistent because the needs of investors today are more global. I don't care whether you're in India or you're in UK. I have businesses everywhere, right? So for that reason, harmonization is important. And remember, if it is prepared in a consistent way, everywhere it's prepared in the same way, then whether you are in Uganda, whether you are in Kenya or Australia, you will be able to understand that information because everybody is using the same thing. So understandability will improve. Understandability from a user's point of view will improve because the information is presented consistently wherever, no matter where you are. Just imagine how our academic journey will be. Say in Finchartered Academy, I teach you in a certain way. My name is Shaz Farafi, right? So I teach you in a certain way. But maybe in XYZ Academy, there is somebody else where they teach you in a different way. In ABC Academy, they teach you in a different way. But imagine the way everybody teaches, it becomes harmonized. Everybody is teaching like XYZ Academy. I also change my teaching style and follow XYZ Academy. Right? So if everybody is kind of unified, it becomes more understandable to people, especially for a business that operates around the world. Forget FR. Again, I have teaching OCD, so I have to give some analogy, even if it is very easy. But we all speak English, correct? In spite of having our own local languages. Why? Because now when we go outside, whether we go to another city in India, I can't know all the languages, or whether I go abroad. I go to the Americas, I go to Europe, specifically the UK. Okay, I go to that part of the world basically, right? I go to Australia, I go to Singapore, I go to Malaysia, I go to the Gulf countries. Most of the countries, knowing English will help me get sorted. Why? Because it's all like everybody speaks English. So I don't have a problem. So even if I go to several countries, I'll be able to understand them. So why should you learn English? So that you understand wherever you go, you can understand people. Using the same logic, again, now that our businesses are going more global, see, financial statements and preparation of financial statements is a language of its own. We need to be able to understand it. And that understandability will come, only everybody will be able to understand if everybody speaks the same language. And that's why harmonization is needed. Right? So these are the advantages of harmonization. So what is harmonization? We've looked at. Okay. Now, again, it's easier for everybody technically. But what are the drawbacks of harmonization? It is difficult to maintain and apply and introduce in different countries because already all the countries have their own factors, whether it's political, whether it's business related, whether it's economic, they have their own factors. And therefore, to apply one common way of doing financial reporting might be very difficult. And again, there are different legal systems that may prevent this kind of harmonization. Okay, in the Gulf, there's a certain legal system. In India, there is a certain legal system. Right? Everybody has a separate legal system, so it becomes very difficult. Okay, so I hope it is clear on what this is. And again, countries may be unwilling to accept another country's standard. I can imagine this. Right? So there are its own challenges of harmonization. So that is all with respect to harmonization. And again, this is something, the role of national standard setters, we also see in the AA tip, right? The role of national standard setters. What is this? Each country would have its own national standard setting bodies, which we've seen in more detail in AA, I think, if I'm not wrong. Now, when it comes to these national standard setters, they set standards that are closer, either they just follow the IFRS standards, or they may choose to have their own standards that are kind of in alignment with IFRS. However, overall, what is happening is the trend towards closer international harmonization of accounting practices is now set. So we are now going more and more and more, instead of being national, we're going more and more international. That's all. Again, there's no numericals in this chapter as such. You just need to kind of know what is what. I mean, it's mostly, as you can see, it's all theoretical piece of information, with which the chapter will be over. So it's all theory. So easy, but very, very easy. Now we're going to look at the IFRS foundation itself, right? So what is this talking about? What is the IFRS foundation talking about? What does it do? What does it not do? Everything we're going to look at. So here, what do you have is the full form of the IFRS, as the name suggests, is International Financial Reporting Standards. Okay. See, this is a global body. Right? So this IFRS foundation is coming with a set of accounting standards that are global, high quality, and understandable. So this body itself is of high importance to us, finance, accounting and finance professionals. So IFRS Foundation is coming with a set of standards that are global, high quality and understandable. So each country originally, when we had our own rules, comparing was made difficult. So in order to bring alignment, we had the IFRS Foundation coming in with these global standards. And the IFRS promotes actively. Obviously, you prepare these standards. So obviously, once you prepare it, you will promote the active use of these standards. So it's like I take class and then I actively promote the use of my classes. Then bringing about convergence of national and international accounting standards. What do we mean by this? Again, as I said, there are local accounting standards and there are also international accounting standards, right? So convergence means bringing down the differences. I told you, we bring down the differences between national and international accounting standards. So that convergence, you're all coming in one line. Okay, so that is what the IFRS Foundation does. Now, what do? We have the IASB. Now, this is the board that actually will be coming in with the accounting standards. Make a note of this: IASB, the International Accounting Standards Board. So, here what we look at is, again, we are the ones that are kind of the chef. We're preparing the dish, the IASB, the board, right? So we have certain steps of preparing accounting standards, which we will look at in the IASB, right? Now, I want to kind of mention a few things uh, that are of reasonable importance. Okay. Um, we have also uploaded the kit on the LMS, right? The kit has been uploaded on the LMS, and I would urge you to start solving the quick kit questions as soon as possible. The earlier you start, the better the chances of clearing the exam. So the tests that will be conducted, the tests that will be conducted will test on multiple things. Number one, it's testing you on the textbook. Number two, I'm going to test you on the Kaplan kit. Number three, I'm going to test you on the BPP kit. And number four, I will test you on the Study Hub practice questions. Number of sums as homework, so you keep it. Yeah, sure. How many sums you should practice? I will mention this. Study Hub practice questions. So again, all of you do have access to Study Hub, your Study Hub. All of you have access to the Kaplan kit, which we've uploaded on the LMS, and the textbook. Now, the only thing that we have to probably share is the BPP kits. And once that happens, you have everything. Literally, there is nothing that is left from you, nothing that is pending, nothing at all. Right? So, if you have any doubts, please let me know. Yeah. Right. So, let's continue. Again, we were at the IFRS Foundation. What is it in brief? It is not a for profit organization. It is an organization, international organization, that supervises and funds the IASB. IASB, we will look at this shortly. It's like you can say the body that is like the head office, where we are looking at how accounting rules are made and applied worldwide. So it is an international worldwide organization, right? So again, what are we doing? Our responsibilities include we supervise the IASB. Again, more on the IASB shortly. And when we supervise the IASB, we make sure the IFRS standards that come out are high quality, clear, and enforceable. And then again, as you can see in the textbook, it makes, you can say it kind of handles governance and funding. We've seen what I mean by funding, but we ensure that they have enough money in place to do their operations. Right? And after that, apart from that, these things I have already explained to you. So just make a note. That's all. Apart from that, nothing else is needed for you at this level. Okay, just you just have to like kind of make a note, and that's it. The next thing is again, we were looking at what? We were looking at the IASB. Okay, what does this IASB do? What does it kind of cover? What happens here is what you will be looking at now. Again, the IASB is the International Accounting Standards Board, right? And here what is happening is this National Accounting Standards. This is the main body that is responsible for creating and issuing IFRS standards. And it works under the IFRS Foundation. It is the IFRS Foundation that funds and supervises the IASB. So IFRS Foundation is like the principal of the school. And the IASB is the teacher. So the IASB is under the supervision of the IFRS Foundation. Now, when it comes to IASB and national standard setters, IASB wants what? IASB wants one global set of accounting standards. One global set of accounting standards. But the problem is ISB cannot force countries to follow IFRS. We need cooperation from national accounting bodies, national accounting bodies. We cannot force anybody, right? So, in order to make this work, see, when you cannot force somebody, what is the next thing you can do? You can kind of convince them in the right way. So, to make this work, national standard setters are part of IASB discussions. So we are I'm asking you also. I'm asking you also what are your opinions? What are your thoughts? I'm also taking you into the discussions. And countries nationally, at a national level, countries review and comment on new IFRS proposals before they become official. That's it. That's all. That's all that is there in this. Right. So there is uh, a mention of everybody being involved, they giving their comments. And Sir David Tweedy, chairman of the board, said there will not be convergence for the sake of convergence by the issue of a set of lowest common denominator accounting standards. This basically what he's trying to say is he said that we will not create weak accounting rules just to make it easy for everyone to agree. Anyway, nobody will ask you what he said, but it's helpful to kind of know this. Next is what is the IFRS? This is the International Financial Reporting Interpretations Committee. See, sometimes we have a language, right? We have a language. Or say we have, forget language, it will be too easy. But say we have a law. But common man may not understand that law. So somebody has to, common man may not understand that law. Because, why? Because obviously he's a common man. So we need somebody to that law. So we need interpretation to the law. Now, this is with respect to law, but the same thing is applied even with what? Even with financial reporting standards. So, whenever we need clarity, the IFRIC helps when there is confusion about how to apply IFRS in real world situations. So the IFRIC comes and interprets and guides you and gives you solution. So it provides quick solutions when different companies interpret IFRS rules in different ways. Okay. So make a note of that. Again, you can see it here simultaneously. Issues rapid guidance on accounting matters where there are different interpretations. So it helps you basically, right? But obviously, we are interpreting, right? When we interpret something, IFRIC's interpretations must be approved by the board. I missed that point. Interpretations must be approved by the board. What do I mean by that? Is I don't know how many of you played the game Dumb Charades, right? But say I'm doing some action, okay? Let me kind of close this day with a little bit of interaction because too much theory can get a little. So this guy, he's doing an action, correct? Now I have to interpret it. Can you people interpret and tell me what is he trying to say? What is this guy trying to say? What does he want to say, ask? According to what I understand, he's asking for coffee. But see, we are interpreting what he's saying, but only he can approve it, correct? Maybe he's asking if, maybe he's asking you to come for coffee, either that, or maybe he's asking you if there is coffee, or maybe he's asking you if you made coffee. I don't know. So we all will interpret it in different ways. And that's why, and that's where the IFRIC comes. It helps in interpreting. But only this guy can say whether the interpretation is correct. Right? Only he will say if he's asking for coffee or if he's asking if there is coffee or if he's asking if you will come for coffee. So that's why, see, the IFRIC, yes, it interprets, but ultimately the board will be the one who will kind of approve and say, yes, this is what we're trying to say. So I hope that is clear, RFIRIC. Okay, with which, again, it's 7:48. So I am going to share my screen, don't worry, just give me 1 minute. So today was Thursday. FR was my last of 4 classes that I took. So you can see the 11 topics covered today. As meanwhile, simultaneously, I will kind of also mark the attendance because for live classes, I have to mark attendance manually. So we have Aradhana. Aradhana, is this your first class that you attended with me or you have been in any class with?
No, sir, this is my first class.
How was it? Were you able to understand things?
Yes, sir.
The previous recordings, please watch it.
Yes, I will complete this by the end of this week.
Okay. So now, the last 10 minutes is spent, as you all know, in kind of reviewing whatever we've done. It's a recap. And you rate your understanding out of 5 for these 11 topics. Okay, Kenny, thank you so much.